If you've been told you don't qualify for an SBA loan, or your credit score is not high enough to get a traditional loan, do not give up on your dream of buying a business. I'm about to show you how to structure seller finance deals so that the seller is excited to be your bank. After helping hundreds of people acquire their first business, I've discovered that seller financing can actually be better than doing an SBA loan, if you know how to structure it the right way. Today I'm going to show you the exact framework we use to get sellers to finance their own business. And I'm going to show you real examples of students who are crushing it using these strategies, including one who's making over $100,000 a year after only putting down $25K. So the basic concept of seller financing is that the seller is becoming the lender. Now, what does it actually mean in reality? So let's take, for example, a $1 million business. And let's say that you're going to be paying the $100,000 in down. So that's 10% down on a $1 million business. The other 90% is going to be seller financed. Now, typically seller finance terms, meaning the length of the loan in which you're repaying back what is owed to the seller, typically can be as short as 3 years, but as high as 10 years, right? So you're kind of working with that method. Sometimes you can even be longer, but many times you're between that bracket. And typically the interest rate is going to be less than what you're paying for an SBA loan. So instead of 10% right now, you'll be paying anywhere between 5 and 7%. Now, with these types of deals, one of the biggest benefits is there's not going to be any personal credit check required. Now, the seller might want to do one for you and they can do whatever they want, but it's not necessarily based on that. And many times these deals are structured without a personal guarantee on the buyer's end. And this is probably the biggest question I get is, why would a seller do seller financing? Like, why would they do that and take the risk? Well, there's a couple of reasons why. Number one is the tax advantages. When you sell a business, you're going to pay a capital gains tax. If you're getting a lot, let's say you're selling $1 million business, you're going to lose up to potentially a couple $100,000 of that price in taxes. Well, one way to avoid paying that high of a tax amount is to do seller financing. So instead of taking a lump sum of money, which you will then pay taxes on, you can spread it out over 5, 7, 10 years, and over time you're getting paid interest on that, so you're going to be making more money, and the tax rate on those payments to you are going to be less, so you're going to be more tax advantaged taking those payments over time than you are in taking it in one lump sum. It's also great because you know exactly what you're going to be making for the next 5, 7, 10 years, okay? So you're going to be paid every month, and you know exactly for the next 7 years you're going to be making $10,000 a month in seller finance payments. So as a seller who maybe has already made their money, they don't need the big lump sum to go and purchase a house or a boat. They're fine with taking those $10,000 payments every month for the next 7 years. That's great. That's something that they can rely upon. That's something that they know is coming into the hopper every single month. And so some sellers are primed for that. The second reason is that there's normally a higher purchase price potential. So because you are doing seller finance, you are not going to negotiate so hard on the price. So for instance, let's say the business is selling for $1 million and you come in and do a seller finance deal. You're not going to come in and say, hey, I'm going to pay you $800K and do seller financing for 90% of the purchase price. You'll never get the deal. But if you come in and say, hey, look, I know you want $1 million. I have no problem paying you $1 million. In fact, I'll pay you even a little higher, $1.05, or I'll pay you $1.1 million if you're willing to do a higher percentage of seller financing. And so over time, especially with the interest they're getting, they're going to make much more money than if they just took that $900,000 offer that was using lending or traditional financing. Now, on the buy side, one of the best things about seller financing, outside of it being something that you can structure with little personal guarantee or no personal guarantee, is that you are incentivizing the seller to stick around and make sure that you are successful in that business. Because remember, you owe the seller these payments for the next 10 years. And so if something happens in the business where you need help, they're very incentivized to help you out, because the last thing they want you to do is to fail. Because now, yeah, what are they going to do? They're going to get back a business that is not doing that well, and they don't want that. They already sold it, they're out of it, they're retired. They want you to pay them every month. And if you need their help or you need some of their expertise, they're going to give it to you because they're incentivized for you to succeed, because they want you to pay them. Another thing to say before I get too much further into this video is a lot of times sellers do this, not just because of the tax advantages, not because just for the purchase price that's going to be higher, but because their business is not in shape enough to have a traditional lender lend on it. When you're trying to go buy a deal, the bank is going to look at the financials of the company because they want to make sure that there's enough cash flow to pay them back. And if the books are a mess, or they didn't have a great performance the last few years, or maybe they're just in an industry that the bank is not even interested in lending on, well, then the seller realizes that no buyer is going to be able to buy their business using financing. And so they have to do seller financing in order to get a sale done. So here's some common approaches that people do when they're structuring these seller finance notes. So they're going to be mostly in a monthly format over a certain term period. So like the deal that we talked about earlier. So a 7-year term on a 5% annual rate, and you're going to get paid monthly back to the seller. Okay, so now that's predictable income, coming to the seller every single month, and they know exactly what's coming into them. Now, many times the seller is going to want a personal guarantee. Now, this is where you can have some negotiation happen. Depending on the deal and depending on the size of the deal, the seller might not care about you having a personal guarantee, or they just are not a big stickler on it because the business has a lot of collateral in it and they are fine with that being the collateral for the note that they're taking on. Okay, so if you were to default and not pay them, they take the business back over, they get all the equipment, they get all the things that are worth a lot of money, and they're fine with that. So that can happen in some deals. Other deals, the seller is taking on a lot of risk and they say, no, you're gonna have to take on a personal guarantee just like you would for an SBA loan. And you can negotiate that back and forth. It's between you and the seller, no one else is involved. So instead of it being for the full purchase price of the loan, maybe you get the guarantee down to half the loan, or maybe even less than half the loan. And then there's other times where the seller doesn't even ask for it. The seller believes in their business, they know exactly what it takes to make that business successful. They think that you have the capability to do it, and that's not even something that they bring up. Now, I would recommend you do not bring up the topic of a personal guarantee because it's in your best interest to limit your downside risk not to have one. But if they were to bring it up, remember that there's 2 to tango here in this negotiation, and come from the perspective of, I want you involved, I'm willing to take on maybe a little personal guarantee, but not for the full amount. We can collateralize the rest of this with the assets of the business and make sure that you are being your best advocate. One of the things you can do, especially when you do a seller finance deal, is you can do performance-based payments for the seller, right? So these are kind of earnouts. When you do an SBA structure, the SBA prohibits earnouts when it comes to their acquisitions, okay? Now there's other ways to get around it, and we could talk about that more in another video, but for seller financing, this is a pretty common thing. So if you're doing a seller finance deal, one of the things that can benefit the seller is that if the business does well and they make sure that you are doing the best you can, then they can get an earnout, right? So that incentivizes the seller to stick around, to be involved in the process, because if this business were to grow at X% year over year, then the seller can get an additional money than what they've already been paid at closing, or what's in the seller note that you're paying on every month. Now, one of the things that's great for the performance-based incentive is that the buyer has the advantage where if it doesn't perform, then what you could do is something called a forgivable seller note. So a portion of that seller note can be forgiven if the business doesn't perform a certain way over the first year or first 2 years. Typically, it's within the first 12 months. So if you have $1 million business, you seller finance 90% of it, so it's $900,000. Within the first year, if it doesn't do 95% of the previous year's revenue, then instead of being that $900,000 that needs to be paid back, maybe $100,000 is chopped off of it. So it incentivizes the seller to really make sure they're helping you out, so that first year you have a really strong transition period. And there's ways that you can make this a hybrid structure. You can do part of it's a fixed payment, part of it's based on performance. The cool thing about seller financing, and you're gonna probably hear me say it multiple times in this video, is that it's up to you. It's up to you and the seller. You guys make the deal. There's no bank involved, there's no underwriter involved, there's no third parties involved. It's just you and the seller doing what makes sense. Have a conversation, throw out some crazy ideas. Right? He's going to throw out some ideas as well and really come to an agreement on what's going to benefit you the most as the buyer and him as the seller. Here's an example of one of my students named Brian, who's actually Canadian. So in Canada, they have kind of 5 big banks up there, totally different lending atmosphere, much harder to do business acquisitions from a traditional lending standpoint. Still possible, but they don't have something like the SBA program in Canada. And so Brian decided that he was going to do a seller finance deal. Brian found a trailer manufacturing company that was an awesome company, and they were selling for $420,000. Now, Brian was able to negotiate that price down to $125,000, right there. He's cutting it in a third, which is amazing. Now, how he structured this is with a $25,000 seller note, which was on full standby for 2 years, which means there was no payments on that note for 2 years. So the note's kind of just frozen. You're not gaining interest on it. Nothing's happening. It's just frozen in time for 2 years before you start making your first payment. It was at a 5% interest rate. And after the standby period of 2 years, it was on a 7-year note period. So no payments for 2 years, and then it would go on a 7-year term where payments are broken up by month. So this was Brian's first deal, and he was able to buy a $420,000 value company for $125K, $25,000 which was on the seller note. The rest came from him upfront to the seller, and he was able to structure this deal that way with the seller, no personal guarantee, and today that business is thriving. So to go down the path of seller financing, there's a couple things you need to do. Step 1, making relationships, right? You want to build rapport with the seller. Seller financing requires a lot of trust on the seller's part for the buyer. And they're not going to give you any type of seller financing if they don't trust you. If they don't think that you can actually make the business run well, keep it profitable, because they're basing them getting paid back based on you running this business successfully. So you need to give confidence to this seller. So on your first meeting, you're going to treat it like you're going to a job interview. Put your best foot forward. Be professional. Talk about who you are. What are your skill sets? Why you're so excited about this opportunity. Really try to build rapport and trust with that seller. Another important aspect of this meeting is understanding what they want to get out of this. Some are just can't wait to retire. Some are sick and they have medical issues. Some have recently got divorced. You really need to start to understand kind of the mindset that the seller's in, because that's going to enable you to try to structure the best seller finance deal. You're also going to have to be very transparent when it comes to your financials, right? If you're not including a bank, they're not doing underwriting, right? So now it's just the seller. Hey, if this guy is the one taking over my business, if something goes wrong, does he have any assets that I can even try to get a hand on in a personal guarantee? So he's probably going to ask you for a personal financial statement. He's probably going to ask for your W-2s and everything else to understand who you are and what you've been able to do. And so don't take offense to this. This is perfectly normal. They're trying to protect themselves. Make sure that you're opening this up in a very transparent dialogue. You're signing an NDA, and both of you are understanding that this information is personal, that is to be protected, and you're putting your cards out so that he can see them, and he's going to do the same with this company. Also, it would really help during this process if you have a detailed business plan. Don't just go into this meeting saying, hey, I think you have a great business and make some good money, and not have any kind of substantive plan of how you're going to benefit by taking over this business. Remember, he's getting paid by you running this business successfully, so he wants to see that you have what it takes to do that. So come to the meeting with a resume, come to the meeting with industry knowledge, come to the meeting with showing, here's the things that I've been able to do in XYZ, and here's how I'm going to be able to do that with your company. The more time and energy you spend in building up that business plan, the more that they're going to get confidence and be able to really negotiate a deal that's a win-win. Last but not least is the transition planning, right? So we want to have a clear idea of how this transition is going to happen. So the owner or the seller in this instance is going to know what the timeline is. They're going to know exactly when the closing is going to happen. They want to see what that process looks like in detail. So the more detail you can give, the more detail that you can write up in the contract between you and the seller, the more confidence they're going to have that you are the person that's going to be able to execute this deal, and they're going to make back all the money that they are financing for the sale of their business. Another key aspect of this is the communication for your employees, right? This is for every sale, but especially in a seller finance deal, because the seller should be very involved after the closing, because again, they're the bank, right? So they're going to have a clear interest in making sure that you're doing a good job. So they're going to be very involved. So you want to make sure that that transition between you and the seller when it comes to the employees is very clear, it's very defined, it's written out in the purchase agreement, the contract between you and the seller, and it's something where it is you guys are both on the same page on how you're going to communicate this transition process to your employees. Now this is pretty similar whether it's a bank deal or seller finance. People think just because banks aren't involved that it's a different process. This is super important. You got to make sure that you are making the transition as clean as possible, going from one owner to the next. All right, now let's talk about how we negotiate these deals. Remember, when you're doing a seller finance deal, you're really trying to do a win-win. You're trying to give the seller what they really need, and in response to them giving you what you really want, which is taking on a seller finance deal with no bank intervention, and you can make this deal as creative and good for you. And so we want to make sure that both parties are a win-win in this. Don't try to come to this with the mindset that I'm going to crush them, I'm going to get the best deal, and there's nothing they can do about it. This is something where both you want to walk away from the deal table feeling super happy at what the result is. One of the things you want to do, because the seller's not going to have a broker that's going to be telling them what the business is worth, is you want to show the seller how you're getting to what the business is worth to you, right? What are you using to value the business? Many sellers, I would say the vast majority of them, have no idea what their business is worth. And so you kind of have the leverage here. You're coming to the table with, I'm willing to offer you X in response to the value of your business, and they can respond back saying, wow, okay, that's great, or that's horrible, I thought it would be more. So make sure the number you're throwing out has a clear methodology behind why you got that number, because they're going to ask. The way that we value businesses here, and check out my other videos, check especially my free course where it goes through this in detail. Just go and find out exactly what the cash flow is, the SDE, and you're going to take that and you're going to multiply it anywhere between a 2 and a 4x. 4x is like turnkey businesses that have a team in place that is doing all the day-to-day. The owner's not very involved. That's a 4x business, and a 2x is the exact opposite. And so you're going to find out where this business lies in between that 2 and 4x. You're going to multiply that by the SDE, and that is kind of the value of the business. So make sure when you're having that conversation with the seller, you're able to break it down exactly how you got to the value. Now, the payment terms are typically 20 to 30% down. Now, I gave the example before where it was only 10% down. You can get it as low down as you want. I've even seen some deals done with 100% seller financing. Now, that's rare. Most of the time it's between 20 and 30% down, up to 50% down, typically, when we're talking about seller finance deals. They're typically structured where there's between a 3-year and a 10-year term. It's usually on a fixed interest rate, typically between 5 and 7% right now based on market, but but typically it's less than what the Fed rate is on seller finance deals. Now, because this is just negotiated between you and the seller, you can structure the deal however you want. You can make it to where it's monthly payments on a 30-year amortization, but the term is only 7 years, and there's a balloon payment at the end. You can do whatever you feel is fair, and it's going to be able to get the seller to the table to sign the dotted line. Now, one of the most important parts of the negotiation period is making sure that the seller involvement is in writing in the contract. You never trust that the seller is going to stay around and help you where you need it, right? They're selling the business. Now, they're very incentivized to stick around because it's a seller finance deal, but you still need to write down exactly what you expect, just like you would for any employee, right? You have roles and responsibilities. You're going to do the same thing for the seller. Whatever it is, they're going to have roles and responsibilities that they are obligated to do, and you need to have that in writing. So not just with their job, but you also have all the things that they're supposed to be doing during the transition period. Now, many times the sellers are going to have key relationships. Well, you're going to want, as the new owner, them to introduce you to these new key relationships. Another part of this is having the seller really start to document all the different things that they do in their day-to-day so that you can take that knowledge with you. Because God forbid, something can happen to that seller. If they're older, they can have a health issue and they can be gone the next day, and then you're left with a business where you might not have all the knowledge to run it successfully. So we want to make sure that we are transferring it to a digital platform where you can access it to know all the knowledge that the seller knew to make sure you can continue to run this business in the best possible way. Now, here's some creative structures that you can actually use when you're thinking about seller financing. Number one is a profit share model. Now, this is something where if you really want to get kind of creative, so a seller, there's seller financing, but this is for the sellers that are doing something in the day-to-day aspect of the business. Maybe they're maintaining relationships, maybe they're now doing sales, but you want them to be super invested, not just with making the monthly payments, but if you're going to do a profit share, you want this person to be invested in the performance of the business. And if they're willing to do that, doing a profit share model works really well because it incentivizes that seller. Not just are they making their seller finance payments, but they're also making extra money based on the success of the business. Another great way of doing this is with a equity stake retention. So this means that the seller is maintaining a certain bit of ownership, small, definitely a minority stake. Typically, it's anywhere between 5 and 20% of the business. Now, what this does is a couple things. One, even after you pay back the seller financing loan, they're still invested because they own a piece of this business. They want to see it succeed, right? They want to have a second exit down the road when you sell, and they get another bonus check from that sale. And so by doing this, you are keeping them in the mindset of an owner. So that means that they're way less likely to do something to hurt the company. They're still going to offer you value even after you pay off the seller finance note. And they're someone that you can use as a trusted advisor because they are an owner like you. Now, here's some common mistakes, and we're going to go through these by each one, and I'm going to explain why they're common and why it's important not to make them. The first one is overestimating cash flow. It is always better to be conservative when it comes to cash flow projections. Anytime that I try to project what a company is going to make over the next couple of years, I'm always going to be on a very conservative mindset because I've done enough of these to know that if I'm very rosy and I think the future is bright, typically we're going to come in less than what I expected because there's going to be extra expenses I didn't see coming. There's going to be some turmoil in the business. There's going to be a whole number of factors that can affect revenues. Now, sometimes we exceed those projections, which is awesome. But anytime you're going to be talking about cash flow, because it is the lifeblood of your business, you need to make sure that you are overestimating what you are going to need. The next one is insufficient working capital. This is why it's so important to have good financial data of the business that you're buying, because you're going to take the average of the overhead expenses, so they're monthly expenses. You're going to take that over the course of the entire year. The highest months, they're going to average that. So let's say that's $50,000 a month in expenses. You want at least 3 months worth of those expenses as working capital when you take over the business. Day one, having access to that 150K, because it's going to give you enough time to make sure that you're getting that business to a positive run rate. One of the biggest issues I see is just horrible communication between the buyer and the seller. And this breeds resentment, this breeds miscommunication, and this is eventually what could cause a downfall in that relationship, which is not what we want, right? Both of us succeed when the business does well, and the business needs us to communicate well. So this is something that is more of an intangible, but you need to make sure that you're on a constant communication timeline with the seller. So you have a standing meeting every Wednesday at noon where you have lunch together and you talk about how the business is doing, or you have a phone call or a Zoom meeting, whatever it is. It's super important that you have this recurring meeting with the seller as an avenue for them to be able to talk about things maybe they don't like that's going on, things that you don't like is going on, and you're going to be able to work together as this team, as this unit, to make this business better. The last mistake here is not seeing things through the seller's point of view. Remember, if they're going to be sticking around in the business, maybe they're doing profit share, maybe they have some equity, or maybe you just have a straight seller finance deal, they have nothing else, but you're making payments to them every month. They're incentivized that the business succeeds. And so when you're doing something that affects the seller, or you're doing stuff with the business, or maybe making some changes and they're still involved, see it from the previous owner's perspective. Is this something where they might take offense to? Is this something that they worked really hard on and now you're just kind of throwing it in the trash because you think it's a bad idea? If that's the case, make sure that you just look at things from the seller's point of view so that you can go have those conversations, open up those clear lines of communication. You don't want any drama between you two. You're both partners in this. You both want the business to succeed, and that the best way to make that happen is to have clear-cut communication. If you're still not convinced that you can buy your first business without an SBA loan, let me share some real results from my students who've used seller financing. Brian acquired his trailer manufacturing business for $25K down and is now making over $100,000 a year in cash flow. Ben and Andrea structured their nail salon deal in a creative fashion with an SBA loan and seller financing, and in the first year they're making over 160% return on their cash. And this is not luck. We've seen dozens of students creatively finance and structure their deals with seller financing who are seeing great returns. If you want to see how to structure seller financing deals just like these, listen closely. I have a program called Acquisition Ace where we hold your hand through the entire acquisition process. You can 100% try to do this on your own, but I can promise you that doing it inside of our community is going to help you not make all the common mistakes that we talk about. Click the link in the description if you would like to learn more. But regardless, I hope that you learned something new today. Thanks for watching.